Welcome to this explainer. Okay, let's jump straight into it because today we are going on an absolute roller coaster ride. We're tracking half a century of the Brazilian stock market, drawing directly from Roberto Teixeira da Costa's brilliant chronological analysis. We're going to explore the massive booms, the devastating busts, and the constant, relentless attempts at rebirth over the last 50 years. If you want to understand the unique DNA of investing in Brazil, how it was shaped by crazy hyperinflation, massive crises, and some truly groundbreaking reforms, you are in exactly the right place. But before we even map out the timeline, I want to hit you with a number that is, well, it's honestly pretty shocking. 0.3%. Historically, this is the percentage of the Brazilian population that actually invests in variable income, like stocks. We're talking less than half of 1%. In a modern, massive economy, that is almost unfathomable, right? So how did we get here? Why are Brazilians so hesitant to invest in their own companies? To figure that out, we have to go back to the very beginning. All right, let's kick things off with Phase 1, the Wild West. This covers the era from before 1965 right up to the massive crash of '71. So picture this. Before 1964, the Brazilian capital market practically didn't exist as a way to fund businesses. People basically just parked their money in real estate. Bank accounts paid these tiny symbolic interest rates, and buying foreign currency hadn't really caught on yet as a way to dodge inflation. Companies? They just relied on standard bank loans or squeezed their existing shareholders. But then, in 1965, the government decided to step in and basically try to force a market into existence. They created the central bank and passed a huge capital markets law. But the real wild card was something called Decree Law 157. It was this totally artificial government stimulus that let everyday people deduct 12% of their income tax, but only if they invested it in special stock funds. I mean, imagine a tax break like that today. Naturally, this created a massive, highly artificial wave of money flooding into a tiny, unprepared stock market. And, well, what happens when an artificial bubble inflates? It pops hard. The year 1971 brought a truly devastating crash. Everyday investors lost their shirts and exited the market deeply, deeply traumatized. For years after that, they literally refused to touch stocks, running straight back to the safety of savings accounts. Moving on to our second phase, building the rules. This takes us through the 70s and into the 90s. So, after the massive hangover from that '71 crash, the government had a real wake-up call. They realized you cannot build a sustainable market on gimmicky tax incentives. You need actual rules. You need proper institutions, and you need heavy-hitting players to stabilize things when it gets bumpy. So they started laying down the tracks. In 1976, Brazil totally overhauled its corporate law and created the CVM, which is basically their version of the SEC. They also forced big institutional pension funds to invest a chunk of their capital in the stock exchange, hoping to provide some long-term stability. But man, this era still had its earthquakes. Enter 1989 and the infamous Nahas crisis. Nahas was heavily leveraged with bank loans and basically tried to corner the entire market, buying up massive, unsustainable positions. When his margin calls finally hit and a $32 million check bounced, the entire system just seized up. The Rio de Janeiro Stock Exchange practically broke that day, and honestly, it never truly recovered its previous dominance. The sheer trauma left behind by the Nahas situation scared individual investors away all over again. Throughout the 90s, the domestic market became heavily institutionalized, dominated almost entirely by state pension funds. Local retail investors wanted absolutely nothing to do with it. Because of this, major Brazilian companies, giants like Acra Cruz, Ambev, and Vale, actually had to go abroad. They started issuing ADRs on the New York Stock Exchange just to raise capital, because their home market was simply too hostile and way too illiquid. Which brings us to Phase 3, taming the chaos. Enter the Plano Real and the Novo Mercado. The 1990s were an absolute game changer. They fundamentally shifted the trajectory of the whole nation and its markets. You see, the biggest enemy of variable income wasn't actually market manipulators. It was the absolute chaos of hyperinflation. But in 1994, the Plano Real successfully killed that hyperinflation and finally introduced a reliable currency. And guys, this is the absolute prerequisite for investing: predictability. When your money is literally losing value every single day, your time horizon shrinks to, like, tomorrow. You can't possibly project cash flows 10 years out. By stretching out that time horizon, the Plano Rail brought independent investment banks back to the table and allowed people to actually look to the future with some level of confidence. Building off that newfound macroeconomic stability, the Bovespa Exchange launched something truly revolutionary in the year 2000. They called it the Novo Mercado. This was a special listing segment that demanded incredibly strict corporate governance. Now, context here. At the time, minority shareholders in Brazil were often treated like second-class citizens. The controlling families held all the real voting power. But the Novo Mercado changed the rules entirely. It demanded 100% common voting shares and equal treatment if the company was ever sold, something known as tag-along rights. People were super skeptical at first, but it proved a vital truth. If you actually protect minority shareholders, serious global capital will absolutely flock to you.
Now for phase 4, and this is the fun part. The golden era, the massive boom from 2004 to 2007.
With a stable currency, falling interest rates, and these great new rules protecting investors, the fuse was officially lit. We went from a practically dead market to 15 IPOs in 2004, to 41 in 2006, and then a staggering 76 initial public offerings in 2007. It was wild. And almost all of these were listed under the strict, transparent rules of the Novo Mercado. But here's the really fascinating twist. The heroes fueling this massive boom, they weren't local Brazilian retail investors. Nope, it was foreign liquidity. U.S. hedge funds and huge international investors were pouring cash into Brazil, sometimes taking up 70% of an entire IPO book. Brazilian stocks were seen as relatively cheap compared to other BRIC nations, and global liquidity was just at historic flood-level highs. But then the music stopped, and we really need to pause here for a second and ask a crucial question. Why couldn't this growth just continue? Why couldn't the Brazilian market become a permanent, reliable engine for corporate funding, like you see in other developed nations? Because instead of continuous growth, the market went into a severe regression. That brings us to phase 5, crises and the recent winter. Basically a perfect storm. To understand why the boom died, you have to look at this totally brutal domino effect of external shocks and internal wounds. First up, the 2008 global financial crisis hit. Remember all those foreign investors who fueled the IPO boom? Well, they desperately needed cash back home, so they sold off their Brazilian assets in massive waves. But then internal problems started compounding the damage. Inflation and high interest rates roared back to life. Then the market was absolutely rocked by the collapse of Ike Batista's EBX group, wiping out massive amounts of wealth. Following that was the horrific environmental disaster at Samarco, which deeply impacted Vale, one of the market's biggest heavyweights. And hanging over all of this was the immense shadow of the Lava Jato corruption investigations and the political impeachment process. Regardless of where you stand on it politically, the factual reality is that it paralyzed state-owned giants like Petrobras and completely shattered national market confidence. But beyond all the corporate and political scandals, there is a harsh mathematical reality holding the Brazilian market back. Let's do a quick thought experiment together. Imagine you had invested 1,000 reais into the Bovespa stock index back in 1994. By 2016, enduring all those crazy crashes and booms we just talked about, your money would have grown to 14,275 reais. Honestly, not bad, right? You grew your money over 14 times. But wait, hold on. What if you took that exact same 1,000 reals and just put it into the CDI? The CDI is basically a totally basic, effectively risk-free, fixed income rate that tracks the government's interest rate. If you did that, your 1,000 reals would have grown to 42,006 reals. That is literally 3 times the return, for zero volatility, zero sleepless nights, and zero market risk. And bam, that brings us right back to our opening statistic. Why on earth would a local Brazilian investor take on the massive, heart-stopping risks of the stock market when their own government pays them so handsomely just to hold debt? This right here is why Japan has 31% retail participation, the US has 13%, and Brazil is completely stuck at 0.3%. Historically, Brazil has practiced some of the highest real interest rates in the entire world. It's a massive structural disincentive. High interest rates are basically the kryptonite of the stock market. Finally, we reach phase 6, the future. Looking ahead at essential reforms and the rise of the new analyst. So where exactly do we go from here? How does Brazil rebuild trust and actually create a lasting capital market, rather than just waiting for another brief window of opportunity? Well, the source material makes it crystal clear. The answer lies in deep structural reforms. To bring inflation and interest rates down permanently, which, as we just saw, is the absolute prerequisite for a stock market to survive, Brazil has to fix its foundation. Economic agents are demanding major overhauls to the tax code, fixing Social Security, ensuring total, unquestionable autonomy for the central bank, and enforcing transparent public accounts. But beyond the macro stuff, there has to be a real cultural shift. Investing in businesses needs to become a habit for Brazilians, not just a gamble. And as the market matures, the professionals analyzing it, they have to evolve too. The traditional, old-school analyst basically looked exclusively at price-to-earnings ratios, cash flows, and market share. But the new analyst, the analyst looking to the future, has to see the entire picture. Value generation today is intrinsically tied to corporate governance, to how a company treats its stakeholders, its environmental footprint, and the diversity of its leadership. And to process this massive, complex web of non-traditional data, this is where artificial intelligence becomes an absolute game changer. The future of investment analysis will heavily rely on AI as a vital tool to map out these metrics and project true long-term sustainability. The modern analyst knows that ignoring these potentials isn't just bad PR, it's genuinely bad for long-term returns. We have literally seen 50 years of the wildest swings, moments of absolute brilliance and, moments of despair. But I want to leave you with this final provocative thought. How can a country as massive as Brazil ever hope to cover its huge infrastructure gaps without a robust private sector capital market? Will the stock market finally evolve into the permanent engine for long-term development that the country so desperately needs? Or is it just destined to remain a fleeting window of opportunity that only opens and closes with the global tides? Thank you so much for joining me on this explainer. I really hope it gave you a completely new perspective on the history and the potential future of capital markets.